This video discusses three economic concepts that you may find on the BEC portion of the CPA exam. And in this case, again, it's going to contain some very, very brief summaries followed by some exam simulation type of questions. Again, as I mentioned to you before, the best way to review this video is to let the question play, stop the video at that point, perform your own analysis, arrive at your own answer, and when you're ready to view the answer on the video, go ahead and restart the video again. Now, as I mentioned, the information that I'm talking about regarding GDP and other areas that I'm going to talk about at a very high summary level, the Khan Academy, again, provides a very excellent review for the different areas that really need to be covered. I'm only covering a very high summary level, but the Khan Academy will talk about how there's a circular flow of like income, expenses, and how to calculate the gross domestic product and so forth. So I would highly recommend that you view these videos. Now you can see on this slide there are 5 videos along with their links for you to review. Also on the following slide there's another 5 links. Now that's 10 links in total. That sounds like a lot, but if you really, all these links contain relatively short videos, and again, Saul Khan does a great job in terms of taking some complex subjects and explaining them very clearly. So I would highly recommend that you do have a chance to review these videos in addition to the summary that I'm doing in this particular video. Okay, now we're going to talk about economic activity in terms of how do we measure economic activity. And there's probably 3 major metrics in this area. And the first one is what we call the nominal gross domestic product, or GDP. And this is the value of all final goods and services produced, and those goods and services produced by domestic and international, not internal entities, but international entities within the territorial boundary of a company, or of a country, I'm sorry. So let's put that in the context of the United States. What this would mean is this would be the value of all final goods and services produced within the United States by both domestic companies and non-domestic, or I'll call them international companies, as long as it's produced within the United States. Now, I also use the word final goods and services. In other words, when we measure gross domestic product, we don't take a look at the value of the intermediate goods and services. We look at, because those intermediate goods and services are going to compose the final goods and services, so we don't want to end up double counting things. Now, the formula for GDP is actually, it's fairly simple. It's consumption, and consumption can be both consumers and businesses, producers, plus investment. However, investment does not include investments in stocks or bonds, plus government spending. Government spending does not include what we call transfer payments, and that would be things such as welfare, Social Security, the tax credits for low-income people, and so forth. These would be transfer payments, so they're not included. And then plus exports minus imports. So typically, again, you're not going to get the questions regarding GDP may not necessarily be complex, but they may ask you what what are the different components that GDP is comprised of, or what particular items are not included in GDP. And again, you can take a look at Sal Khan's explanation of those items in his videos, and they're quite good and they're quite useful. Now, the next term we have is what we call, the next question we have here, if I get it back here, is real GDP. Okay, real GDP is the value of all final goods and services adjusted for inflation to remove the impact for inflation. In other words, you're able to compare the real GDP of one year against the real GDP of last year, and they're both stated in terms of the same dollar amounts. So you can actually determine if real growth or decline has occurred. We do this adjustment, we'll see this in the next slide or two, through what we call a deflator or series of deflators. The third area of measuring economic activity is through what we call the gross national product, not to be confused with the GDP. And that's the value of all final goods and services created by domestic, in other words, if we put it in the context of the U.S., created by domestic producers or U.S. producers, whether those producers are within or outside of the domestic territorial boundary. So this would be basically any U.S. producers, whether they're within the United States or outside of the United States. And GNP equals GDP. Sorry, I've got to go back again. GDP plus income earned by residents from overseas investments minus the income earned within the domestic countries by overseas residents. Okay, now let's take a look at number one. And again, this is a type of question that would be a very common question in the exam regarding GDP. Which of the following would be excluded from GDP? So again, stop the video, do your analysis, come up with your own answer, and when you're done, go ahead and restart the video. In this case, the answer would be for the expenditures for the purchase of common stock. Remember the formula, GDP equals consumption plus investment. However, investment does not include expenditures for stocks or bonds, plus government spending, but government spending does not include transfer payments such as welfare or Social Security, and plus exports minus imports. And again, the reason certain things aren't included, we don't need to go into that complexity. Saul goes into some of that. But it's basically to eliminate the possibility of double counting. Okay, now let's take a look at, we talked about the measuring nominal GDP against real GDP. And we do this through what we call a deflator, where we convert basically the present GDP back to a previous GDP by using this deflator. And we do these through what we call indices. And the two that are probably the most likely one, if there's going to be a question asked about it, it would be the Consumer Price Index, or the CPI. And that's the value of a fixed basket of goods and services compared to the same basket in the previous period. So what we do is we compare the current basket, the value of the basket of goods and services today, versus a basket previously, and we look at the price changes. And what we could do is we could see that the inflation caused that basket to increase by 4%. So when we take a look at the current, the nominal GDP for the current year, we know that it's 4% higher simply due to inflation. So that would not be considered growth in this particular case, because all that would be was an increase due to inflation. So we're going to use a consumer price index for certain, basically certain elements of consumer final goods and services 2, we're going to deplete that back to the previous year to determine whether or not there was actually a true increase or decrease. In other words, comparing apples to apples. We also have what we call the producer price index, or the PPI, and that's a value of a fixed basket of goods at the wholesale level compared to the same basket of goods value in the previous period. And again, that will be used in a deflation calculation to squeeze out any inflation factor that occurred in the new year. And so we can compare the current year against the previous year with an apples to apples type of comparison. Now, we're going to talk also in summary about the multiplier effect and the associated concept of marginal propensity to consume. Now, the impact of a marginal increase of income in our economy has what we call a multiplier effect on gross domestic product. And the income earned is respent multiple times in the economy, thereby increasing gross domestic product. Let me give you an example. You pay somebody $100 for something, for let's say some type of service. That person is going to receive that $100. And of course, they're just not going to keep it in their pocket. What they're going to do is they're going to spend that $100. So again, the money that you just spent adding to the GDP is going to be spent again as that additional person goes ahead and pays other people. And those other people then are going to respend all or a portion of that dollar again that they've received. So what happens is, this is called a multiplier effect. So when you spend $1, what would happen is that that dollar is actually multiplied many times in the economy, increasing the GDP. Now, the multiplier is based upon an economy's what we call marginal propensity to consume, or it can be abbreviated as MPC. So if you see MPC, you need to know it's marginal propensity to consume. Now, let's take this concept and do a real simple calculation. Let's assume that we have $10,000 of disposable income we've basically added to the economy. Let's say that we've just received that. Now, the word disposable income is an important term because, again, you could be asked a question about that, disposable income. That's your income minus any taxes. And when you think about it, that's very logical. That's your disposable income. Now, assuming that we have $10,000 of disposable income, it's added to the economy. In other words, we receive that money. And the economy overall has an average MPC, in other words, marginal propensity to consume, of 0.8. That means for every dollar you receive in disposable income, you're going to spend 0.8% of that, or 80% of that dollar. And then the next person, when they receive that, is going to spend 80% of what they've received, and so forth. So what you should also know is the formula for the multiplier. And the formula for the multiplier is your marginal disposable income, which again is your disposable income. In other words, marginal means your additional disposable income, divided by your marginal propensity to consumer, by your MPC. So let's take the $10,000 example in the MPC of 0.8. We take $10,000, we divide it by the quantity 1 minus 0.8, so that's going to be $10,000 divided by 0.2, that's going to be $50,000. So by $10,000 being added to your spending amount, your disposable income, what will happen is, based upon an MPC of 8, actually $50,000 is going to be added to GDP because of the $10,000 marginal disposable income being added to the economy. Now, there is a corollary to MPC, and we call it MPS. and it's the marginal propensity to save. And if you think about it, it's very logical, because if we have a marginal propensity to consume of 80%, logically, our marginal propensity to save then is that other 20%. So the marginal propensity to save is what we don't consume. And again, MPS stands for marginal propensity to save. And if you see that, remember that's what it means. So the marginal propensity to basically to save is your 1 minus your MPC. So if the MPC is 0.8, then the MPS is going to be 1 minus 0.8, which would be 0.2. And you can see the example right here. So you can be asked questions about calculating the MPS or the MPC. Okay, now let's take a look at question number 2. And I have a space, I have a slight typo there, but number 2 is disposable income is computed as. Again, stop the video, do your analysis, arrive at your solution, and then when you're ready, restart the video. Okay, if you remembered from your previous slides, is basically the answer in this case would be disposable income is computed as income minus taxes. So the answer in this case would be C. In other words, the amount you can consume or save. Okay, let's go on to the next question. And you'll notice question numbers have skipped. I apologize for that. I will correct that in the PowerPoint slides, but we don't really have to worry about the numbers at this point. Okay, an individual receives $10,000 in disposable income for the month. The individual spends $8,500 for goods and services. So what is the individual's average propensity to save? Now, it can also be called marginal propensity to save. So average propensity and marginal propensity, as far as we're concerned, at this point in time is the same thing. So again, stop the video when you're ready to start. When you've arrived at your answer, go ahead and restart the video to review the answer. Okay, number 2, and the answer in this case, and again, I'm back to my question numbering issue. In this case, what is the individual's average propensity to save? In this case, it would be B, 15% or 0.15. And if we take a look at it, we're consuming, it's a very simple computation. Sorry, my system went okay. It's actually a very simple computation. It's a matter of taking, again, if we have $10,000 and we spend $8,500, that means we spent 85% of our disposable income, which means our MPC would be 85%. So we would have $1,500 out of that $10,000 saved, or 0.15%. So that would be our calculation. Okay, let's try number 3. An individual receives $10,000 in disposable income. The individual spends $8,500 for goods and services. The individual receives an additional $1,000 and spends $900 of it. What is the individual's marginal propensity to spend? It looks complicated, but it's really not that complex. We'll go over the answer. And again, go ahead and stop your video. When you're ready to start it again, the answer, go ahead and start it. Okay, in this case, the answer is 90%, or 0.90 C. Now, if you take a look at it this way, we had a marginal propensity to consume at one point in time, or you could call it the average propensity to consume of $8,500 per month. But now what we find out is this individual receives an additional $1,000. In other words, a marginal amount of disposable income. And now they're spending $900 of it. So we have a new computation, because what happens is we would say now we're spending $900 of $1,000, which means our marginal propensity to consume now has gone to 90%. So in this case, the answer would be C, 90%. And this ends the instructor video 3-2.